Welcome to the deep dive. We are thrilled you could join us today.
Absolutely. It's a great topic we have lined up.
Yeah. And if you're watching the video feed right now, you'll see our visual backdrop is this, well, it's this massive, stylized, interconnected web of corporate buildings.
That's right. Spanning across a glowing globe.
Exactly. It looks a bit like a futuristic transit map. But what it actually represents is the staggering complexity of multinational conglomerates. You know, the modern corporate empire. And our mission today for you, the listener, is to decode the ultimate corporate jigsaw puzzle: group audits and consolidated financial statements.
It is a massive puzzle.
It really is.
Yeah.
Because when a company has, say, hundreds of branches, holding companies and subsidiaries all scattered across the globe.
Operating in different currencies, too.
Yeah, different currencies, different jurisdictions, entirely different regulatory environments. How do we know the consolidated numbers aren't just, well, smoke and mirrors?
Right.
I mean, how do you actually audit a labyrinth?
Well, it is arguably the most complex challenge in modern accounting.
Yep.
Oh, without a doubt. And my core belief has always been that critical thinking is absolutely essential in our current world of information overload.
Oh, definitely.
And in the financial markets, that critical thinking isn't just encouraged, it's enforced by a highly sophisticated framework of auditing rules.
So it's not just a free-for-all.
Yeah.
Yeah.
Not at all. We are talking about the invisible infrastructure that keeps the global economy transparent. I mean, without these mechanisms, capital markets simply couldn't function.
Because the trust in the mega corporation would just evaporate.
Exactly. Completely evaporate.
Okay, let's unpack this. We have a really solid stack of documentation today mapping out that infrastructure.
I do.
We're looking at the mechanics driven by Indian accounting standards, or Ind AS, the SEBI LODR regulations, and some key standards on auditing.
Specifically, SA 600, 705, and 706.
Right. And we're going to translate this dense auditor speak and examine the actual on-the-ground scenarios where these regulations force these massive organizations to show their true hand.
Which is where it gets really fun.
It does. So to see how this works in practice, let's look at a scenario involving a company called Mox Ltd.
Ah, yes. Mox Ltd provides a perfect structural baseline for this discussion.
Yeah, set it up for us.
So we are dealing with a listed parent company that doesn't just operate as a single monolith. It has 7 unlisted subsidiaries.
Right, we'll call them Component A through Component G.
Exactly. And the principal auditor navigating this whole group is a firm called Sambov & Co.
So you have one auditor looking at 8 different entities.
Right. And when an auditor looks at a structure this fractured, the immediate operational challenge is resource allocation and risk assessment.
Because you can't be everywhere at once.
You cannot audit every single transaction across 8 different entities with the same level of granular intensity. It's impossible.
Which brings up the concept of materiality. You have to figure out which of those 7 subsidiaries actually has the power to, move the needle on the consolidated financials.
Precisely. And for listed entities, Regulation 16C of the SEBI LODR regulations establishes a very specific quantitative threshold for what constitutes a material subsidiary.
So it's not just a subjective judgment call by the auditor?
No, it is a hard mathematical line. Yeah. Under Regulation 16C, a subsidiary is classified as material if its income or its net worth exceeds 10% of the consolidated income or net worth of the entire group.
And that's based on the immediately preceding accounting year, right?
That's right. So the auditor looks at the aggregated pie. If a component is contributing more than 10% of the total earnings or holds more than 10% of the total equity value,
it demands heightened scrutiny.
It demands massive scrutiny.
And the numbers in the Mox Ltd scenario really illustrate how quickly a subsidiary can trigger that threshold.
Let's run the numbers.
So the consolidated group income is 600 crore. Component A brings in 70 crore.
Which is about 11.6%.
Right. And Component C brings in 140 crore, jumping over 23%.
So both are material based on income.
Exactly. And then you look at the balance sheet. Component D has a net worth of 280 crore against the group's 1,600 crore.
Making it over 17%.
So A, C, and D are unequivocally material.
They hit the 10% rule.
Right. But identifying them is just step one. There's a secondary threshold that shifts this from just an accounting issue to a corporate governance mandate.
And that is where Regulation 24(1) comes into play.
The 20% rule.
Exactly. If a subsidiary's income or net worth breaches the 20% mark of the consolidated total, it triggers a direct oversight requirement.
So the parent company can't just let that subsidiary operate autonomously anymore.
They absolutely cannot. The regulations demand that at least one independent director from the parent company's board must be appointed to the board of that unlisted material subsidiary.
Wow. And in our Mox example, components C and D both exceed that 20% threshold.
Right, so the parent company is legally required to parachute an independent director straight into the boardrooms of Component C and Component D.
That's a huge intervention.
It is. And if we connect this to the bigger picture, the regulatory intent here is brilliant.
How so?
It specifically targets the risk of localized corporate governance failures destroying the parent entity. Historically, we've seen massive publicly traded companies hide extreme leverage.
Or toxic asset.
Exactly, or highly speculative ventures, and they hide them in these unlisted, unmonitored subcompanies.
Out of sight, out of mind.
Precisely. By forcing an independent director from the parent to sit on that subsidiary's board, the regulator ensures there is an unfiltered line of sight from the parent's governance structure directly into the operations of its most critical components.
Essentially neutralizes the blind spot defense. The parent can't claim they didn't know what the subsidiary was doing.
Exactly. They have their own person in the room.
Now, that structural line of sight is crucial when things are running smoothly. But what happens when the auditor hits a wall?
And they often do.
Right. So in the Mox scenario, we have these 7 components, but let's say the financials for component F and component G are entirely unaudited.
Okay, so a blind spot for the auditor.
Yeah. The principal auditor, Samhav & Co., is trying to sign off on the consolidated financial statements, but significant pieces of the ledger simply haven't been verified by anyone.
This represents a severe scope limitation, and the auditor's response is dictated entirely by whether those unaudited components are material.
Going back to that 10% rule.
Exactly. The framework relies heavily on SA 705, which governs modifications to the auditor's opinion, and SA 706, which deals with emphasis of matter and other matter paragraphs.
Let's isolate component F first. It is classified as material to the consolidated financial statements, but it remains unaudited.
So Samhav & Co. is effectively blind to a critical portion of the group's financial reality.
Right. What do they do?
In that situation, Samhav & Co. lacks sufficient appropriate audit evidence, or SAAE. You simply cannot issue a clean, unmodified opinion on a consolidated entity when a material piece of it is a black box.
Because the potential for undetected misstatements in component F could be pervasive enough to materially alter the group's overall financial health.
Exactly. Under SA 705, the principal auditor is obligated to evaluate modifying their entire audit opinion for the consolidated group.
Which is a huge deal.
It's massive. Depending on the pervasiveness of the possible misstatements, this could mean a qualified opinion, or in severe cases, a complete disclaimer of opinion.
That is a blaring siren to institutional investors.
Oh, absolutely. Modifying the consolidated opinion essentially alerts the market that the parent company's financial reporting apparatus is fundamentally compromised.
But the regulatory treatment for component G is completely different just because it falls below the materiality threshold.
Right, because component G doesn't have the mass to distort the consolidated reality, even if its unaudited numbers are completely wrong.
It's a rounding error, basically.
Essentially, yes. Therefore, a lack of audit evidence for G doesn't invalidate the overall financial statements. Instead of modifying the core opinion under SA 705, the auditor utilizes SA 706.
The other matters paragraph.
Right. They include an other matters paragraph in the final report. It's purely a disclosure mechanism.
Just to cover their bases.
Yes. It tells the reader, for full transparency, this immaterial component was not audited, but its exclusion doesn't impact our assurance regarding the consolidated picture.
It's fascinating how the exact same operational failure, an unaudited subsidiary, results in 2 wildly different regulatory actions purely based on the mathematical weight of the component.
It really highlights the immense pressure on the principal auditor to establish those materiality thresholds correctly from day one.
Which brings up the challenge of relying on other professionals. We have another scenario involving a professional named C.A. Tushar.
Right, the principal auditor taking on a new group.
Yeah. He is evaluating an appointment as the principal auditor for a parent entity and its 3 subsidiaries. But the standalone financials of those 3 subsidiaries are being audited by completely different firms.
The component auditors.
Right. So what does he do?
The complexity multiplies exponentially here. Standard on Auditing 600, using the work of another auditor, establishes the protocol. Tushar cannot just accept the component auditor's reports at face value and staple them to the parent's financials.
He can't just take their word for it.
No. Before he even accepts the engagement, he must evaluate whether his firm's involvement is significant enough to act as the principal auditor.
He has to look at the big picture.
He has to assess his knowledge of the component's businesses and the risk of material misstatements originating from the work of these other auditors.
He essentially has to audit the component auditors.
In a way, yes. He needs to evaluate their professional competence and ensure their methodology aligns with the group's requirements.
And a critical part of that alignment involves determining materiality for the group as a whole.
Precisely. When the parent company's management goes through the consolidation process, eliminating intergroup transactions and making consolidation adjustments, Tushar needs to evaluate those adjustments against a group-level materiality threshold.
Because if he allows the component auditors to operate solely on their own localized materiality levels without a coordinated top-down strategy,
the consolidated adjustments could easily mask systemic errors. The math just wouldn't work at the top level.
here's where it gets really interesting. Coordinating domestic auditors is one thing, but look at a scenario like Najib Limited.
Ah, the cross-border scenario.
Yes, this is a formidable operation supplying the U.S. building and construction market. They're dealing with a turnover of 1.9 billion rupees, spanning 11 different business units and 170 branches across multiple international jurisdictions.
It's a massive footprint.
Massive. The parent company is based in India, adhering to Indian Generally Accepted Accounting Principles, or Indian GAAP. But their massive subsidiary operating in the United States prepares its financials under U.S. GAAP. You have entities within the exact same corporate structure, legally bound to entirely different accounting frameworks.
The cross-border reconciliation problem. It is the ultimate test of consolidation mechanics.
How do they even begin to merge those?
Well, when a material component utilizes a different financial reporting framework, the principal auditor cannot simply consolidate the raw numbers. Revenue recognition, lease accounting, inventory valuation, they might follow completely different rules.
Apples and oranges.
Exactly. But standard practice offers two primary mechanisms to bridge this gap.
Okay, the first mechanism relies heavily on the parent company's management. Management takes the subsidiary's audited financial statements, prepared under U.S. GAAP, and systematically converts them into Indian GAAP.
Right. They calculate the adjustments necessary to align the accounting treatments.
Then the principal auditor evaluates and audits those specific conversion adjustments to ensure they are accurate for the consolidated statements. But doesn't that introduce a massive bias risk? I mean, management is essentially marking their own homework before the auditor sees it.
It does introduce risk, and that requires rigorous substantive testing by the principal auditor on those conversion entries.
Which sounds incredibly tedious.
It is. That is exactly why the second solution is vastly preferred in highly complex multinationals.
The Group Accounting Manual.
Yes. The subsidiary adopts a group accounting manual. This is a comprehensive, systemic solution. The manual hard codes the parent company's accounting policies compliant with Indian GAAP, directly into the subsidiary's reporting requirements.
So instead of the local U.S. auditor issuing a report based purely on U.S. GAAP and leaving the translation to management,
the local component auditor audits and reports specifically based on the policies dictated by the Group Accounting Manual.
Oh, that's smart. It streamlines the data right at the source. The component auditor verifies the numbers using the parent's rulebook, so the data arriving at the principal auditor's desk is already standardized.
It is significantly more efficient, but it requires the principal auditor to perform upfront procedures ensuring the Group Accounting Manual genuinely complies with the framework applicable to the parent.
Trust, but verify the manual itself.
Exactly. And there is an overriding principle here that you, as the listener, must grasp. Regardless of whether management converts the financials or a group accounting manual is used, the auditing framework itself must ultimately correspond to Indian Generally Accepted Auditing Standards, or Indian GS.
So the standard of the audit can't drop just because it's happening overseas.
Right. If the component auditor's work does not meet the rigorous evidentiary standards of Indian GS, the principal auditor cannot rely on it or reference it in their final report. The underlying architecture of the audit must be uniform.
The logistical coordination required to enforce that uniformity across 170 branches is staggering.
It really is an operational marvel.
But as rigid as these consolidation requirements are under the Companies Act and Ind AS, the framework is surprisingly adaptable when the underlying economic reality of a business model demands it.
The exception to the rule.
Yes. Let's look at Jambu and Sitarma Investments Ltd. They pooled 12 crore rupees from multiple clients to invest in shares and debentures purely for capital appreciation. And they hold a controlling stake in a subsidiary called Investors Fund Management Ltd. Now, a strict reading of Section 129 of the Companies Act suggests that if you control a subsidiary, you must prepare consolidated financial statements.
Under a rigid, unthinking application of the rules, yes.
But they don't, do they?
No, because the regulatory framework is designed to reflect economic substance, not just legal form. Jambu and Sudharma Investments Ltd. actually bypasses consolidation entirely, and the mechanism for this exemption lies within Ind AS 110.
Because they qualify as an investment entity.
Unequivocally. Their sole business purpose is managing funds for capital appreciation or investment income, and crucially, they measure and evaluate the performance of substantially all their investments on a fair value basis.
Because they operate functionally like a mutual fund or a private equity vehicle.
Right.
Forcing them to consolidate would actually distort their financial reality for the shareholders.
Precisely. The purpose of consolidation is to provide a unified view of a parent and its operating subsidiaries as a single economic entity. If an investment firm buys a 60% stake in a manufacturing plant, a retail chain, and a software company,
Just to hold the stock.
right, consolidating those distinct operations into the investment firm's financials creates a chaotic, meaningless aggregate. The investment firm doesn't operate the manufacturing plant. It merely holds the equity for yield.
So under Ind AS 110, fair value measurement becomes the only metric that actually matters.
It tells the investor exactly what the portfolio is worth on the reporting date, which is far more transparent than a convoluted line-by-line consolidation of unrelated businesses.
It's a perfect example of regulatory flexibility reflecting economic reality. And we see another fascinating application of this flexibility when we look at accounting estimates.
The depreciation paradox.
Yes. Take the scenario of HCO Ltd., a holding company with two subsidiaries, ARCO and ESCO. The parent company and ARCO utilize the straight-line method for depreciation. ESCO, however, uses the written-down value method.
Different methods for wearing down the value of assets.
Right. If you are consolidating these entities into a single group financial statement, it seems totally counterintuitive to allow mixed depreciation methods for similar assets.
It does seem counterintuitive until you analyze in AS 8.
Which says what?
It distinguishes between accounting policies and accounting estimates. A change in the method of depreciation is classified as a change in an accounting estimate. The fundamental goal of depreciation isn't to create uniformity on a spreadsheet.
It's to reflect reality.
Right, to accurately reflect the expected pattern of consumption of an asset's future economic benefits. If ESCO utilizes heavy machinery that rapidly loses its economic utility in its early years, the written-down value method accurately reflects that reality.
And if ERCI uses assets that degrade evenly over time, the straight-line method is appropriate.
Exactly. As long as the distinct methods faithfully represent how the assets are being consumed by each specific entity, mixing them in a consolidated statement is entirely permissible.
So the regulations allow for varying operational realities. However, in this specific case, Arcunes is using the straight-line method, but they are failing to apply component accounting for their high-value assets.
And that is where the regulatory flexibility hits a hard stop.
You can't just ignore component accounting.
No. Under AS 10 or Ind AS 16 regarding property, plant, and equipment, component accounting is not a suggestion. It is a foundational requirement. If an asset has multiple distinct parts with significant costs and different useful lives, each part must be depreciated separately.
You can't apply a single 20-year straight-line depreciation rate to a massive commercial aircraft if the engines need replacement every 5 years while the fuselage lasts for 30.
Precisely. By ignoring component accounting, Arcune is violating a base standard. The principal auditor will flag this immediately. You can vary your estimates to match reality, but you cannot ignore the structural rules governing how those assets are recognized.
So what does this all mean for you, the investor or the analyst, actually trying to read the final consolidated document?
That's the real question.
Because if a principal auditor is rigorously evaluating dozens of component auditors, adjusting for multiple JAPs, allowing for different depreciation estimates, and enforcing component accounting across hundreds of subsidiaries, the sheer volume of data is astronomical.
It's overwhelming.
Let's look at ABC Limited. They are consolidating BBB Limited, where they hold a 51% equity stake, and TTT Limited, where they hold 63%. When management sits down to prepare the final notes to the consolidated financial statements, how do they prevent the document from becoming an unreadable, 1,000-page data dump?
This raises an important question, and it's perhaps one of the most critical yet underappreciated aspects of financial reporting, the curation of data.
The decluttering phase.
Yes, Section 129 of the Companies Act dictates that the consolidated financial statements must be prepared in the same manner as that of the standalone company. But the principal auditor and management must enforce a strict filter regarding the notes to the accounts. Only information that is material and relevant at the group level is retained.
The filtering process is incredibly aggressive. When consolidating, they strip out highly specific localized disclosures.
Right. They omit the source from which a subsidiary's bonus shares are issued.
They remove granular disclosures required under the MSME Act.
Detailed breakdowns of foreign currency expenditures on royalties.
Or the exact percentage of imported versus indigenous raw materials used by a single subsidiary. Those operational footnotes exist in the standalone financials, but they are deliberately erased from the consolidated view.
And this raises an important question about the philosophy of transparency. We are conditioned to believe that more data equals better transparency.
Give me everything, right?
Exactly. But in the context of a massive multinational conglomerate, unfiltered data is actually a weapon of obfuscation.
Hiding in plain sight.
Yes. If you force an analyst to wade through 30 pages detailing the foreign consultation fees of a minor subsidiary in a different hemisphere, you dilute their ability to see that the group's core operating cash flow is deteriorating.
So less is more.
The omission of non-relevant, hyper-specific component data isn't hiding the truth. It is protecting the integrity of the big picture view. It focuses the reader entirely on the systemic risks and economic drivers that actually impact the group as a consolidated entity.
It's an architecture of clarity built through deliberate omission, which is beautiful in a way.
It's highly engineered.
And what we've explored today is that group audits are far more than just mathematical exercises in aggregation. They are deeply intricate, highly regulated frameworks, from strictly enforcing the 10% materiality thresholds that prevent subsidiaries from operating in the shadows to mandating group accounting manuals that synchronize international branches.
These standards exist to ensure that corporate complexity cannot be used to mask economic reality from the public markets.
Without a doubt. When you understand the underlying mechanics, how an auditor evaluates a lack of evidence under SA 705, or how Ind AS 110 prevents investment entities from distorting their balance sheets, you gain a profound analytical advantage.
Absolutely. You realize that a consolidated financial statement isn't just a summary. It is the highly contested, rigorously verified outcome of thousands of professional judgments designed to force a fragmented corporate empire to tell a single, verifiable truth.
You stop seeing the numbers and start seeing the methodology behind them.
Which changes everything.
It really does. And that leaves us with one final provocative thought for you to explore on your own. Throughout this discussion, we've relied heavily on the concept of materiality, the 10% thresholds, the decision to modify an opinion under SA 705 rather than just adding a note under 706.
Human frameworks.
Right, these are human frameworks designed to optimize limited auditing resources. But as global financial systems become fully digitized, we are rapidly approaching an era where artificial intelligence will conduct these group audits.
A fascinating prospect.
If an AI system has the computational power to instantly ingest and verify 100% of every transaction across every subsidiary in every jurisdiction simultaneously, does the very concept of materiality become obsolete?
That's a paradigm shift.
If there is no longer a need to sample data or ignore the immaterial components to save time, do these regulatory thresholds survive? Or does the entire foundation of auditing shift from human judgment to absolute mathematical certainty?
It's the next frontier.
Something to deeply consider the next time you analyze a multinational's annual report. Thank you for joining us on this deep dive. Keep questioning the architecture behind the numbers, and we'll catch you next time.